In 2009, Miami's Brickell district was defined by unfinished towers and distressed sales, an urban dead zone written off by most. Yet over the next 15 years, allocators who acted against the market's panic converted crisis into a 425% return on equity. How did one of America's most battered neighborhoods become the Manhattan of the South? And what exactly made this asymmetric opportunity invisible until it was gone? Let's examine the forensic case history that rewrote the rulebook. In the decade following the financial crisis, Brickell's real estate market delivered an outcome that defied both local skepticism and national trends. Property values in the district climbed 85% from their post-crisis lows, a figure that stands out against the backdrop of United States urban recovery. For the allocator who deployed capital into a luxury condo with a standard 20% down payment, the effect of this appreciation was multiplied by the leverage inherent in the transaction. The result was a 425% return on initial equity, a performance rarely matched in public markets over the same period. This outcome was not the product of speculative frenzy or short-term volatility, but of disciplined capital allocation during a window when asset prices were compressed and liquidity was scarce. Brickell's transformation into what is now called the Manhattan of the South was not simply a matter of rising buildings or changing skylines. It was a function of asymmetric opportunity, where a select group of investors recognized the latent value embedded in a market most had written off. The empirical record shows that those who acted in 2009 captured a return profile that redefined the calculus for urban real estate investing. The data does not rely on anecdote or projection. It is a matter of recorded price indices, transaction histories, and the arithmetic of leverage applied to a depressed asset class. By late 2008, Brickell's skyline was defined by unfinished towers and silent construction cranes. The financial crisis had left the district with a glut of unsold units. More than two-thirds of Miami's property sales involved distressed assets, including bank-owned foreclosures and short sales. Prices per square foot collapsed. Auctioned condos in developments like Icon Brickell and 500 Brickell traded below $300 per square foot. Headlines warned of a lost decade, and local brokers struggled to find buyers willing to take on the perceived risk. For most, the environment was defined by fear and uncertainty, not opportunity. Yet beneath the surface, the mechanics of the market were quietly resetting. Construction activity halted, removing the threat of further oversupply. Lenders wrote down losses, and banks liquidated inventory through REO auctions at steep discounts. From 2010 through 2015, the absorption of these distressed units gradually stabilized the market. Transaction volumes began to recover, and price compression reversed as excess inventory was cleared. This period of forced deleveraging and asset liquidation created a rare entry window. Those who acquired property from 2009 to 2011 did so at valuations that would not be seen again. The market's recovery was not immediate or smooth, but the groundwork for asymmetric appreciation was laid in these years of distress and slow normalization. By 2014, the construction freeze that had defined Brickell's post-crisis skyline ended, as new permits cleared, and luxury projects restarted across the district. Approval records from the city show a sharp uptick in high-rise development applications, signaling renewed institutional confidence. Between 2016 and 2020, a wave of luxury expansion swept through Brickell. The area became a magnet for overseas capital, with property records and brokerage data highlighting a surge in buyers from Latin America and Europe. These groups, often seeking both wealth preservation and dollar-denominated assets, provided a global demand floor that insulated prices from local volatility. At the same time, state policy delivered a structural advantage. Florida's 0% state income tax, in contrast to rising tax burdens in states like New York and California, prompted a migration of both individuals and entire firms. The years 2020 and 2021 saw financial companies and investment managers, including Brickell Capital Finance, relocate significant operations to Miami. This migration was not anecdotal. Corporate filings and press releases from the period document a steady stream of new office leases in Brickell's glass towers. The cumulative effect was a dramatic influx of capital. While precise tracking of foreign direct investment at the neighborhood level remains elusive, Miami as a whole recorded over $15 billion in international inflows during this window, much of it concentrated in its financial core. Brickell's re-rating as a global investment destination was now anchored not only in property appreciation, but in sustained corporate and capital migration. The district's demand profile shifted from local and regional buyers to a pool of global allocators, setting the stage for the leverage-driven returns that would follow. During the 2022 to 2024 cycle, Brickell's pricing structure reached new territory. Standard condominiums stabilized at a baseline of $750 per square foot, while the upper tier, branded residences, and trophy penthouses commanded well over $2,000 per square foot. For allocators modeling capital deployment, the mechanics of return shifted decisively from simple appreciation to the mathematics of leverage. A typical financing structure in U.S. urban real estate allows for a 20% equity contribution, with the remainder funded through debt. This capital stack means that every percentage point of asset price growth is amplified 5 times at the equity level, assuming the debt remains constant. Applying this model to Brickell's actual appreciation, the 85% increase in property values since the post-crisis nadir translates into a 425% return on the original equity invested. For example, an investor who acquired a $750,000 condo with $150,000 down and $600,000 in financing saw the unit's value rise to $1,387,500 over the period. The outstanding debt, largely unchanged in nominal terms, allowed nearly the entire value gain to accrue to the equity position. This is the leverage multiplier at work, asset growth that, when paired with a modest down payment, delivers a return profile rarely matched in public markets. It is important to note that while this 5 times equity amplification was structurally available to qualified buyers, the actual prevalence of high leverage in Brickell's luxury segment was tempered by the dominance of all cash and low LTV international buyers. Nonetheless, for allocators who accessed the standard financing, the result was a mathematical transformation of price movement into extraordinary equity multiples. The interplay between price bands, capital stack, and leverage defines the logic that underpins the retrospective thesis, an outcome grounded not in speculation, but in the disciplined application of financial engineering to a recovering asset class. Rental income played a decisive role in shaping the Brickell investment profile. By December 2025, the average rent reached $5,311 per month, with occupancy rates consistently ranging between 90 and 95%. This level of demand meant that landlords faced minimal vacancy risk, and units were typically absorbed within weeks of being listed. The rental market's resilience provided a steady cash flow buffer, allowing owners to offset ongoing expenses such as taxes, insurance, and association fees. In 2024, Miami's property value growth registered at 11%, but it was the combination of capital appreciation and sustained rental yield that insulated leverage positions from volatility. The liquidity of the market, with properties turning over rapidly, further distinguished Brickell from slower luxury corridors. This operational strength underpinned the total return, ensuring that income generation was not an afterthought, but a core component of the district's investment thesis. By June 2025, Brickell's luxury condo market faced a supply inflection point. Active inventory reached 1,637 units, a figure not seen since the post-crisis absorption years. This surge coincided with a sharp contraction in transaction volume. Sales in the $1 million to $3 million bracket dropped from 157 in the first half of 2024 to just 99 in the same period of 2025. While nominal price growth persisted, the annual appreciation rate slowed to 5%, trailing both the broader Miami average and the district's own historical performance. Developers, including JDS Development Group, encountered a dramatically more selective buyer pool, with prospective purchasers weighing the cost of capital against a backdrop of rising inventory and longer marketing times. The data underscores a fundamental reality. Backward-looking, return models anchored in the asymmetric entry of 2009 cannot be projected indefinitely across new cycles. As the market transitions to a buyer's environment, even well-capitalized projects must navigate a landscape defined by elevated supply and diminished urgency among buyers. Today, Miami's Brickell district faces a cooling market, with inventory at its highest in years and growth slowing below city averages. Capital flows and leverage magnify both risk and reward. For allocators, the next asymmetric entry point isn't in the past, it is in the data unfolding right now.